Good morning and welcome to this Monday, November 7th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got the jobs report out of the way, we got the Fed out of the way, and now this Thursday, we've got the next episode of inflation here in the U.S. CPI report will be out Thursday morning. The two big events that really have been spooking the stock market have been the Fed meetings and that CPI report. Fed, of course, spooked the market again last week. We did see a little bit of strength into the close on Friday, but that was more, the Dow Jones and the S&P seemed to do better than the NASDAQ. Many of the aggressive areas struggling last week. A lot of my ratios turned back down. There's definitely some mixed signals. Back in June when I called the market bottom, pretty much everything was lining up bullishly. And I'm still bullish. I haven't changed anything, mostly because I'm not getting everything lined up bearishly. There's definitely been some deterioration, but I think a lot of it has to do with the confidence of the market in the Fed. I think the Fed is kind of taking things a little deeper than what the market was anticipating. And I honestly think the bond market's pretty smart. So I don't know. We'll see what happens as we go throughout the rest of the year. We still got, almost 2 months left in the fourth quarter, which historically is the best quarter of the year. That's one of those things that are still pointing bullishly. We've got sentiment indicators, which I think have come down quite a bit, which is good. A lot of the fear, even when the market sells off, we'll show you the VIX and the VXN, which is the basically volatility for the NASDAQ 100. I'll be showing you those today during the show, and you can take a look at it. But anytime the market goes down and the fear goes down with it, I become much more bullish because it's just telling me that we're running out of sellers. We're running out of folks that are panicked, and that's usually a good thing. We've still got the equity-only put-call ratio up in the 0.75 area, which is good. So not only is the VIX and the VXN coming down with the market coming down, we also have the volatility index, the equity-only put-call ratio suggesting that the market's at a bottom. So there's literally we have things on both sides. I could argue both sides right now pretty easily. If you wanted to argue the market's going down. So with that point, it just comes down to me, price action. I think right now we've got the low on the S&P 500. I think we set it at 34.91. We're well above that level right now. We're still actually on the S&P above where we were in mid-June when I called the market bottom. So even though we did go to new lows, we've bounced back and we've held this area. It's been more sideways consolidation, more choppiness, more churning than anything else. But let's go ahead and get going here. I do want to mention to everyone we have an event tonight that is free. It's our sneak preview of our top 10 stock picks. It's for our portfolios. So if you are interested, you want to make sure that you are signed up for our free newsletter because we will send out room instructions later today. So if you go over to earningsbeats.com and you scroll down, and by the way, we have our fall special starting in 5 days. So that's for both members and non-members if you want to take advantage. The best time to take advantage of it is right now, because we'll run that special for a week or so. And if you start your trial now, you get 30 days, but you'll get 7 days before our special starts or 5 days before our special starts. And then during the special, you'll have it. So you'll have a pretty good sense of whether you like the service. And if you do, take advantage of our best deal of the year. But anyway, if you scroll down, this is where I was heading. Earnings Beats Digest newsletter. This is a 3 times a week newsletter, very quick read. I generally just provide a couple paragraphs in a chart. It could be a trading candidate. It could be something about what I'm seeing in the stock market. Maybe it's making me more bullish or bearish. Occasionally, I might write about the equity only put call ratio and what that's telling us. It could be a lot of different things, but we tend to focus on earnings and relative strength, candlesticks, price volume, trend lines, moving averages, a lot of the what everyone follows, a lot of the technical analysts, what they follow. So we got all that in the Earnings Beats Digest. So all it takes is a name and an email address, no credit card, You can unsubscribe at any time. We do this simply to give back to the community, teach folks about technical analysis. I think it will help in your investing, not just your trading, but your investing, to learn more about how the stock market works. Anyhow, make sure you check that out. And again, we have a free event tonight starting at 4:30. That is a sneak preview of our draft. So if you're not familiar with what we do, or one of the things we do at Earnings Beats, we have portfolios. And what I do is every 90 days, every 3 months, I pick 10 stocks to go in each of our 3 portfolios: model, aggressive, and income. And we hold those 10 stocks equal weighted for 90 days. So you're basically, it's 10% into 10 different stocks, and you hold for 90 days. This quarter that we're in right now, 2 of the 3 portfolios are doing better than the S&P 500. The aggressive, which has been one of our better, actually had a rough week last week. We were outperforming until last week. There were probably 3 or 4 stocks got hit pretty hard in the aggressive group because of earnings that came out. A lot of the growth stocks that didn't perform well last week. Anyhow, if you look back over time, though, I think our track record's pretty solid. Model portfolio since the middle of the trade war in 2018, that's when we started this, up 111% versus the S&P's 40%. The aggressive up 81%. That started in 2019. That was just before the pandemic, 10 months before the pandemic started. And that's versus 32%. So 81 versus, or 82 versus 32. And then the income portfolio lags since the inception, but honestly, I would expect it to lag. Because if you're in a secular bull market and growth stocks lead, which they have over the past 3 years, even though we've gone through some pretty rough patches the last year or two, income, stocks that are paying dividends, you don't think of those as aggressive stocks. They're more value oriented. So if you're in a secular bull market, chances are if you're in an income fund, you're probably going to underperform because these stocks are not going to appreciate the way growth stocks will. So you just have to keep all that in mind and evaluate, what you want. But 18% in an income-oriented portfolio, not bad over the last 3 years, considering what the overall market's done. And then we also have a model ETF portfolio, which is up about 1.75% this quarter. Still trailing a little bit since inception. We got caught I know there was one quarter we underperformed by about 9 percentage points because we were in a lot of stealth growth ETF funds, and the quarter that was the February to May period of 2021 when the inflation all of a sudden soared and growth stocks were absolutely hammered. I think it was that quarter that got us. But anyway, we've been battling back and having a pretty good quarter this quarter. But this is what we're talking about, though, the stock portfolio. This is what we will have a draft next Thursday night, not this Thursday, next Thursday. So it'll be on the 18th of November. Tonight will be the sneak preview, talking about the things how we put together this portfolio. I'll be looking at the market, looking at what's leading the market, what's been lagging, what areas are we going to be interested in, maybe take a look at some individual stock charts, and just take a look at which ones have been performing well since their earnings. The whole reason that we do this as of this time of the quarter, it's always after earnings kind of are done. So this is another big week of earnings. Next week, we'll have a pretty good solid week. And then we'll start to level off quite a bit in earnings. Last week was the biggest earnings week. And so this week, it's a pretty big week. And then next week, will start to tail off. And then following that, things really begin to slow down. So that's the timing. That's why we do these, why we do the portfolio selection when we do. All right, moving on to what happened on a Friday. Well, we were selling off after the Fed meeting, which was last Wednesday. That's when the meeting concluded. We had the policy statement on Wednesday. Fed Chief Powell said another 75 basis points. That is not what sent the market down. The market knew that was coming. But the Fed talked about ultimately rates were likely to move higher than they previously expected, that these rate hikes were very likely to go on. They were going to be watching data and so forth, but they said had a little bit more of a hawkish tone than they had previously. That was the big difference. And the market didn't like it. Especially the growth stocks took another hit to the downside. So we're seeing a lot of our sustainability ratios moving lower. I know the QQQ versus the spider has moved to a new low. It's been moving straight down. Intraday relative action is not nearly as bearish, although that also turned down last week. So, I want to make sure we give the bad with the good. That's not, that's certainly not anything that is pointing to a market recovery. If anything, that's the opposite. One of the other things I want to point out is that some of the accumulation distribution lines have started to weaken more. And what we saw back in secular bear markets, we saw, through the first 6 to 12 months, we saw pretty strong AD lines, but usually by the time you got to the next leg, a big leg down in a secular bear market, these AD lines started falling apart. So I'm just going to point this out because this is one thing I've pointed to all year, saying, hey, this is manipulation. The AD line's been strong. We've been setting new highs as we've been moving down. Well, we are starting to see some deterioration, not a lot. S&P, you can see right there, did break to about a 3 or 4 month low. The Dow is still holding. The NASDAQ is right on the edge. It's nearly, it's just about at a 4 month or 3 month low there as well. Mid caps, small caps look a little bit better, still above their recent lows, but just want to point out things are deteriorating a little bit. Dow was up 402 points on Friday. S&P was up 50 points back to 3770. The NASDAQ, 132 points back to the upside. So on a percentage basis, all three ended about even. I can tell you that the NASDAQ underperformed badly on Wednesday and Thursday and early on Friday, and it did come back strongly toward the end of the day, which was nice to see. We like to see that continue. Mid caps up 39, small caps up 18. So on a percentage basis, these two actually outperformed a little bit. From a sector perspective, materials up 3.5%. Big day, breaking back out above this recent congestion. So I think we could see a run here in the materials group if the market remains strong. Let's see if we can maybe make a run back for 80 or 81. Financials remain one of the leaders, up just under 2% on Friday. But you can see really nice action here, especially look at what the financials are doing here relative to what the NASDAQ is doing. If you want to know why the Dow is outperforming, right here, take a look at financials and then look at industrials over here. Those two, that's why you're seeing the Dow outperform. Because while 3 of the 5 aggressive groups, technology, discretionary, communication services, underperform, the other 2 aggressive groups, financials and industrials, are crushing it to the upside. So some of this aggressive money that's not in the groups that we like to see moving higher, it's rotating over into the groups that also are pretty important. If you're thinking about recession, you're thinking about a bad market ahead. Why is money going to pour into financials and industrials? Makes no sense. But we did run on both of these charts. I want you to look at this potential neckline. Move down, left side of the neckline, lower low, back up, right side of the neckline. It's bullish, but we got more work to do. Same thing with the financials. Down, left side of the neckline. There's the inverse head or reverse head, back up, neckline, potentially right shoulder back down to the 20-day. A breakout, you see the financials trading above 35 and industrials back up a bit above about 97. That would be a really good indication that we're not going to keep going lower. Maybe as long as the rates are problematic, we continue to see technology, discretionary, and communication services underperform. That's certainly possible. But I'm telling you, when that yield turns and that yield starts to move back to the downside, I really believe you are going to see a huge rally in the NASDAQ, and you're going to see technology, the discretionary area, and communication services all begin to pick back up again. Now, I don't know when that's going to happen. I can tell you that I believe it's January when we normally see the technology group begin to really soar again. So maybe we've got more of this choppiness and rotation longer than what I anticipated. I don't believe that we're going to just fall apart. I just don't see it at this point. I'll tell you some other reasons in just a minute. 10-year Treasury yield, let's get an update here. 4.161, so 4.16. Just kind of, I don't know. I saw somebody looking at the 10-year Treasury yield calling this a cup. I don't think it quite looks like a cup to me. When I see a cup, I want to see it go all the way back up. I mean, this ain't going to hold much water. So you want to kind of see that cup go all the way back up to the prior high. I mean, otherwise, you could say, hey, if you see a cup and you think that's the handle, that's fine. The problem is you break out of the right side of the cup and you haven't even broken out above the left side of the cup. So I could see this maybe being a cup, but not quite being all the way back up to where we needed to be. But down here on the bottom, what you can see is that the financials and the industrials, normally what we see is when rates are going up, we see financials and industrials outperform, because normally when rates are going up, it's because either the economy is strengthening or the market is anticipating economic strength. That's normally why the yield goes up. And both of those, I mean, those reasons are reasons why you would see industrials move higher. If you're expecting more economic strength ahead, transport should do well. Financials should do well, because as rates move up, as long as they're not moving up for inflationary purposes, if rates are moving up, normally what that means is higher net interest margins in banks. Now, a little bit different, when we're seeing it go up earlier this year, it was a lot of inflation fear. And so that's not necessarily a good thing. Actually, it isn't a good thing for financials or for industrials. And you can see with that huge rise in the yield, we really weren't industrials were flat, financials were coming down on a relative basis. But with this move up, we are seeing both groups take off. I mean, normally I would say that's bullish action, but we're not seeing it with the other key groups that drive the S&P. Listen, the S&P isn't going to go anywhere without financials and without technology and financials. Let me start this again. The stock market's not going to go anywhere without technology and consumer discretionary. They make up close to 40% of the S&P 500. So if they're lagging, how's the S&P 500 going to go anywhere? We're going to have this choppiness until we get these two groups going. So for those of you who are looking at this saying, hey, Tom, how can the market go up with technology and discretionary not performing well? I agree with you. I think they're eventually going to turn up, and I think that's what's going to drive the market higher. But I completely agree with you. Right now, the reason the market's going nowhere is because technology and discretionary stocks are not performing well. And you can point directly to the rising rates. So if you believe rates going to keep going up, you think inflation's going to keep going up, I would stay the heck away from the stock market. I really don't think the market goes anywhere. But I'm not in that camp. I've been wrong about interest rates and about inflation. It certainly lasted a lot longer. And I even wrote one of the articles I talked about. We had our event on Saturday about market manipulation. And I think it was back in March, one of my articles, because when we started the year, I thought, okay, we're going to go back down to 4,300 from 4,800. I thought that would be the minimum downside just based on all the signals. And I said, we'd have to kind of monitor things throughout the year and see how bad things got. I figured if things really got bad, I said back on January 8th that we could go to 3,500. That was my worst case scenario. And our low was 3,491. I mean, we got right down to that low. But back in March, when we broke down and we really started to lose some key support levels, that's when I said, this weakness may go on for more than just the first 6 months of the year. It could go much later into the year, which could impact the timing of the rally. So I still think we're going to rally into year end. I just don't believe we're not going to. But I think I'm going to say that in the first half of the year, this is going out on a limb, big limb, but I'm going to say by the first half of the year, we're at an all-time high on the S&P 500. We'll see. I could be completely off my rocker. I know many of you think I am already. But that's what I'm seeing. I think that sentiment has been reset. I called for that back at the beginning of the year. That was really important. In fact, let's move on because I'm going to talk about some of that too. Here we got the S&P 500. Okay, we're moving lower. But look where we are right now. Look where we were in mid-June when I said bottom is in. I mean, we did have a 700-point rally. Thought that was a pretty good call. But I didn't see this coming. And it was this candle right here, Jackson Hole, Fed Chief Powell, more pain ahead. Thanks, Chief. I think this delayed everything. I don't think it changed anything. I think it delayed everything. I think the Fed's talk, it was kind of like Greenspan back in 1996 when he said irrational exuberance, the market went down. And then for the next 4 years, it went straight back up. Why? Because Greenspan's not a stock market prognosticator. He was the Fed chief. So I don't like these Fed chiefs that kind of throw themselves into the market and try to forecast the market. They have no business. What he wants to do is basically he wants the stock market down for a period of time. He wants unemployment up, which is kind of strange. And I actually had someone comment at the event on Saturday when I mentioned that. They're like, wow, you're really making a bold statement there saying the Fed wants higher unemployment. They do. They want the market to weaken. They want to beat inflation. That's number one. They have two mandates: stabilize prices, i.e. inflation, and two, maximize employment. But they don't both have to go hand in hand. Right now, the Fed has picked their bigger fight as inflation, not the economy. They want to squash inflation. Good news is that's great for the stock market long term. I agree with the Fed. We do not want an inflationary environment. We saw what happened to that in the 1970s. We don't want that. I think they might be going too far, and you want to be careful because you don't want the nasty cousin deflation. And if you kill the economy too much and inflate, and then supply side picks up, you could have an issue with inventories. The Fed wants a soft landing, maybe a very mild recession, kill inflation, and then we're good to go. Remember how the Fed had no policy tools when they had interest rates at zero? Well, we don't have to worry about that anymore. Fed certainly has plenty of tools now in case we do move into a recession. Anyway, that's my take. I think the market right here is just churning. I think that between the Fed and these inflation reports that have been coming out, we're continuing to see, well, actually the inflation report's coming out strong. They're coming out hot. But that is what's been driving the market to the downside. I'm still seeing a lot of manipulation in terms of gap downs versus actual selling intraday. Now, I said last week, and even over the last few weeks, that's changed somewhat. And I'm going to show you a chart here in just a minute. In fact, let's keep going. I'll get to that in a minute. Here's the S&P 500 moving down, and here is the VIX. Notice on the way down all the way through, well, really through March, even May, we started putting in lower VIX readings on these lows. But here we went down, the VIX spiked to 30. Here we went down again, the VIX was 32. Then we come down again, the VIX was 36. Next time we came down in May, the VIX only went to 35. Next time only went to 34. Next time down in here, it went just below 34. And what's really interesting now is that last week we were coming down, and look what the VIX did. The VIX went down. Look at any other time period. Down, up, down, up, down, up, down, up, down, up. I mean, the VIX and the S&P are inversely correlated. As the market moves lower, what happens is people begin to panic. Market makers know it, and you've got option prices. The premiums get more expensive. That's why the VIX goes up when the market goes down. When the market starts to go down and the VIX goes down with it, options are being priced less expensively. It makes no sense. Why would market makers be willing to sell options at lower premiums unless the market wasn't going to keep going down? Again, this is just one signal. I'm not saying, hey, the market's going to go skyrocketing because of this. because I got some bad news to show you too. We've got a really choppy, mixed market right now. Here's the put call ratio. As we go down, put call ratio. This is the reset, by the way, I've been talking about that we needed all year. 5-day moving average. All of last year, really for the last couple years coming into 2022, 5-day moving average of the put call ratio. If it got to 0.6, it was high, which historically is way low. Normally, historically, you got to get up to 0.75, 0.80 to really begin to see a lot of bearishness creeping into the market. So back in January, I said, we need to see this reset. We need to see those 0.75, 0.80 readings. We need people to believe that the market can't go back up ever again, unfortunately. And the only way you get there is with selling. Well, look at what we've done throughout this bear market. Look at what's happening to the 5-day put call ratio. Now look at how the readings now are sitting up here at 0.75 up to 0.85. This has gotten back to the more of a norm for a bear market to end. Does every bear market end when we get up here? No. Secular bear markets don't end here. We stay here for a while. So this is not a slam dunk guarantee that the secular bear or the cyclical bear market is over and we're going to go straight back up. Could this be a secular bear market? Yes, anything can happen. When I say it's a cyclical bear market, it's my opinion. Secular bear markets can happen. They can happen anytime. I just don't think it's going to happen. Historically, the market tends to be in cyclical or secular bull markets for 20 years or thereabouts. We've been in this one for 10. I don't think it's time. I think we needed to reset the sentiment. I think all the Reddit folks, the Wall Street Bets folks that felt like the stock market was an ATM machine, all you do is buy calls and make money. I think they found out that's not the way the market works. And unfortunately, we needed this pain. Now those same folks can't believe the market has a chance to go higher. Okay, well, we'll see. We're going to find out. Let's see who's right. So anyway, we've completely reset sentiment, which is a good thing. Now, you want to talk bad things? S&P 500 had been going down. Remember at the beginning of the year, one of the warning signs, S&P going higher. These relative ratios, my sustainability ratios, were not supporting that move. We were going lower. Wall Street was positioning into defensive areas. Now we go down and the selling of aggressive areas continues all the way down to May. See that? That's where we bottomed, May. S&P went down one more time in June. We did not set a new low on any of these. Sound familiar? Doesn't it look the opposite of what we saw back in December? Out of that, I thought we were gone. I did. I thought we were heading back to all-time highs. I had thought first half of the year down, second half of the year up. Here we go. And then Jackson Hole happened. And, I mean, let me be fair. Inflation, we've had a couple bad inflation reports too. It's not just the Fed. But the market is not positioning for inflation. Inflation kills the dollar. The inflation kills your currency. Our currency has been going straight up for the last several months. Everybody, because I keep talking about gold, gold's not a hedge. And people are saying, well, that's because it's a dollar. It's the dollar going up. Folks, inflation eats away at the dollar. It's supposed to weaken the dollar. Why are you going to buy the dollar if we've got runaway inflation? Well, the reason they're buying the dollar is because the U.S. is taking the most aggressive action against inflation. That's why the dollar is acting so bullishly versus other currencies around the world. That's why gold's going down, because folks don't believe inflation's a problem in the U.S. Anyway, I'm done with that rant. Oh, and I did want to show you one more thing on this chart, though. I thought it was here. Oh, I showed you the VIX right there. Okay. So the NDX. So here's the NDX going down. And you can see, by the way, there's that AD line going down. We are trading a little bit below that June low. And this is where that relative strength comes in. I'm talking about. It's 9:30, by the way, market just opening. I'll try to wrap this up pretty quick. But I wanted to show you one other NASDAQ 100 chart. So here we're going down. Look at the NDX or the VXN. This is the CBOE NASDAQ 100 volatility index. So this is the volatility index for the NASDAQ as opposed to the VIX, which goes with the S&P. The VXN goes with the NASDAQ. So we go up, come back down, and then look at this drop where the VXN's not going up. Wait a minute. Technology got killed last week. And the volatility, the expected volatility is going down. Listen, I don't make this stuff up. I just point it out. That is unusual behavior. Maybe it'll turn out to be nothing. Maybe the market goes down, this thing turns back up, and we go up and set new highs. Could happen. It's not happening right now. So here is the technology versus the S&P 500. I mean, we're about to move to a 26, 27 month low. Maybe we just did. Looks like maybe we went just a little bit below that prior low. That's not good for the NASDAQ. It's not good for the S&P. S&P's, what, 27% weighted in technology stocks. Apple had a horrible week last week. One of its worst weeks probably in the last 20 years. Discretionary was starting to come back in September, just past that Jackson Hole meeting. But since the inflation reports have come back out, hot or hotter than expected, there you go. We had another big inflation report this Thursday. Not just the report, but how the market reacts to it's going to be really important. And then communication services. I'm going to go ahead and end it at this one. Those can be your three you must see. I mean, these three relative charts, communication services is just absolutely horrendous. Internet stocks, media agency, broadcasting and entertainment, publishers. Those are the things that are in communication services. They are just awful. They just look horrible. That's the relative performance. Here's the actual performance. We are almost back to the pandemic low on communication services. For the S&P to get there, we'd have to go to 2191. We're still at 3,700 and change. But communication services, just to give you a little flavor, another 10%, they're there. That's how bad this group has been. Anyway, let's take a look at the market. Not a whole lot of earnings this morning. I think BNTX reported. That's one of the pharmas. I think they work with Pfizer. Anyhow, here's the market. Dow Jones leading, again, on a percentage basis or on a relative basis. Dow Jones up almost 0.5%. S&P and NASDAQ closer to 1/3 of 1%. Small caps, mid caps doing better. Let's take a quick look at the sectors, and then we'll wrap this thing up. Financials leading. That's been the theme. Communication services having a little bit of strength here. Technology and consumer discretionary, once again, not there. So mixed picture. I mean, I don't know what else to say. That's kind of my theme right now. Mixed picture. You want to argue bearish? I can give you arguments. Mostly the way the money is rotating and has been rotating for about the last 3 weeks. Bearish, no doubt. No excuses. Bearish. Rates, I think, are part of it, but that needs to turn. Market's not going higher if that doesn't turn. Bullishly, I mean, I can make all kinds of bullish arguments. Talked about most of them here, but sentiment certainly is reset. Sentiment starting to look really bullish in terms of the VIX going down with the market going down. That rarely happens. So anyway, that's all I had for today. I'll be back tomorrow over at Stock Charts TV. So at about 9 a.m. tomorrow, just go over to Stock Charts. You don't have to be a member. Just click right there on Stock Charts TV and you'll be able to come in and watch the show. We'll see how the earnings come out. Still got a bunch of earnings coming out this week, so keep an eye out for those as well. I use this to do a lot of homework. I use the earnings season, to do a lot of homework. We do a lot of research, checking out bet the best earnings versus the earnings we want to, companies we want to stay away from. And then we put all that to use when we go to do our portfolio draft next week. So hopefully see a bunch of you later today at 4:30. Otherwise, maybe I'll see a number of you tomorrow over at Stock Charts TV. Have a great day, everybody. Happy trading.